What is the excess earnings method of business valuation? Well, this is a very interesting approach that really combines an asset-based approach with a value of projected cash flows from intangible assets. So here it is in summary. You take the value of your tangible assets, the things that you can physically touch, your equipment, your inventory, your property, things of that nature, and you estimate what is the return expected from those assets. There's a couple of ways to do that. And then you say, what is the expected return that you can attribute to goodwill or intellectual property or intangible assets? And then you divide that by a capitalization factor to determine the value of that goodwill. And together, you can say, well, that's the total value of the firm. So it's generally represented by this formula, with V being the value of the business, E of A being the earnings attributable to a return on assets, right? Your tangible assets. And then R of A being the appropriate capitalization rate that you would say is associated with those tangible assets. And what does that mean? So basically, if you had these tangible assets, what would be the expected return on them, the value of them if you were to put them out there in the market? Is it the market return, or is it simply the amount of money you would need to borrow to acquire those assets? So your capitalization rate can be based on either of these depending on the nature of the tangible assets. The easiest probably is to say, what is the value out there in the marketplace, and what would you be able to get those assets for in terms of if you were to secure money from an investor to get those assets. And you would divide the expected earnings associated with the tangible assets by the discount rate to say this is the value of those tangible assets. And then you do the exact same thing for goodwill. You would try to attribute a certain amount of earnings above whatever you see as the earnings attributable to the tangible assets, and attribute all of that to goodwill. And then you would again divide that by a discount factor to give you the total value, right? The value going forward over time. And you add these together, and that's the value of the firm. An alternative approach might be to say, what's the normalized value of the company? And then you, once again, multiply whatever you believe the rate of return for those assets over a period by. And then you say, well, the normalized rate of return is higher than whatever the expected return on assets are. So you'd say that E of A, right, the expected return on assets, you subtract that from your normalized return, and whatever's left over, that's how you get the returns attributable to goodwill. And then you, like I say, do the exact same thing, divide it by the discount factor. It all amounts to the same thing. The objective here, separate tangible assets from intangible assets, divide them by their respective discount factors, and then add them together, and that is going to give you the value of the firm. So this is the excess earnings method, and can be very useful for startup ventures that are heavily dependent upon the possession of intellectual property or intangible assets as part of their valuation.